and CEO of RockTenn, with us this morning. When I went to work for RockTenn a little over 10 years ago, some guys I'd worked with called me and said, what in the world are you doing going to work for a company that's an industry that's low growth, low margin, highly capital intensive, highly competitive, and generally destroys shareholder value? And it's a fair question, I suppose. In some respects, they were correct. With regards to RockTenn, they were incorrect. And when you look at under Jim's leadership over the last 12 years, RockTenn the sales have gone from 1.3 billion to 10 billion. EBITDA, which is a kind of a cash flow income statement measure that a lot of people in the industry follow, has gone from approximately 180 million to 1.4 billion this past quarter on a trailing 12 basis. In fact, I think this past quarter, RockTenn made more money in the quarter than we did the first year Jim was CEO. Month of June. Sorry, in the first month, we made more money than we did the first year Jim was CEO of RockTenn. RISI is a industry kind of follower and the kind of the global leader of publishing industry across the forest products and paper industry. And in 2008, Jim was named North American CEO of the Year. He was awarded that again in 2011. In 2009, he was the Global CEO of the Year through the Pulp and Paper Institute that was awarded to him in Munich, Germany. For me personally, I take a lot of pride in when we go to our plants and interact across the divisions and through the company to see the sense of pride that a lot of our employees take in the success the company's had under Jim's leadership, and where we've been, where we've come, the respect that we've gained, and where we hope to go in the future. So to discuss that in more detail, I'd like to introduce Jim Rubright.
Thank you, Tim. And I'd like to thank everyone who came here today. There are a number of friends, people who work at RockTenn, a number of people who've been part of our success at EY, Accenture, and other people who are suppliers to us. And we thank you very much for your contributions to our company. I also am honored by the opportunity to speak here at this school in particular. I didn't grow up in Georgia, so I didn't go to Georgia, but two of my children went to Georgia, and when I started work in 1972 at King Spalding, I worked with any number of people who had gone to the University of Georgia or had gone to the Law School of Georgia. We've got a number of people from Georgia at RockTenn. So I've followed with sort of hometown pride the growth and the quality of the education and the reputation of the University of Georgia, but particularly the Terry College of Business. So it really is an honor for me to speak here today and a privilege, and I appreciate the opportunity very much. I'm going to show you a picture first. And this is a picture of some of the things that we operate. In this corner, this is a containerboard mill. It's located in Panama City, Florida. We take basically logs, chip them, pulp them, put them in a series of processes that end up with containerboard. So a brown box package like this starts out looking like that. That's probably the lowest cost recycled paperboard machine in North America, located outside of Syracuse, New York, in a town called Salve. This is a folding carton plant. These are two very high technology German printing presses. If you use puffed tissues instead of Kleenex tissues, they came off one of those two printing presses. That's Clinton, Iowa. And here is a box plant that's located in Mooresville, Tennessee. I'm going to flip to another picture and then come back because there's a point here. This is a map of RockTenn's 240 manufacturing facilities in the United States, Canada, and a few outside the United States. But look where they are. I am passionate about manufacturing in the United States. And I believe that throughout history, value creation, particularly in the industrial age, manufacturing has been the wealth creator of societies. Our plants are generally located in rural areas. If they're not in a rural area, they're in a small town. Very few of them are actually in cities. In those towns, if you're an engineer and you want to go home to Hodge, Louisiana, Demopolis, Alabama, you pick it. That paper mill or that folding carton plant is the best job for you. If you happen not to be fortunate enough to be an engineer, a doctor, lawyer, or small business person, and you happen to live in Clinton, Utah, Alabama, Waxahachie, Texas, this job right here as a master printer operating that printing press, making $18 an hour with health care, retirement benefits, and a very secure future, if your job's secure, is the best job that you're likely to have in your county. Many of our facilities anchor entire communities. point of all this is that I'm very proud to be one of 850,000 people that work in the paper and forest products industry today. And my job, my success, really depends upon my ability to play my part in making that person's job competitive and sustainable in a global economy, and to do so in the face of a government that is basically doing everything it can to eliminate manufacturing in North America. Here's a statistic. I said I'm one of 850,000 people working in this manufacturing industry. If you start in 2007, when we had a sea change in the political environment in North America, that happens to be 550,000 fewer people that were working in that industry in January 1, 2007. So today we're going to talk about business and success in business. And I think you've seen all I'm going to say about the first element of business success, and that is passion. If you want to be successful in today's global economy and anything that you do, go find something you can be passionate about, because you got to take this seriously and play hard. I am serious about this. I am passionate about it, and I'm unbelievably proud of the people that I work with that have produced a globally competitive business. Now, I'm really not here to talk about what we could do from a political environment to make us successful. I'm here to talk about what one company did to be successful in spite of it. I talked to Tim about what would be the best approach, what would you like to hear, what would be most productive if we talked about it and answered questions. And it's really not talking about RockTenn today. If you want to learn about RockTenn today, just go to our website, click on the Investor tab. In the Investor tab, get our most recent investor presentation. You're going to have 15 or 20 slides. Click on the webcast, and you'll hear me just do the investor presentation. And so you can get a picture of RockTenn today and really everything that we would want you to know about our company today and our prospects going forward. But this is Terry College of Business, and I see a back row full of people who are getting their MBAs, have gotten their MBAs, many people starting out in their careers. So what we're going to do is actually we're going to make RockTenn a business case. We're going to talk through it as a business case, and you're going to have the opportunity to see it through our eyes as we started, when Tim and I started, when Steve and I started, 1999, 2000 at RockTenn. There's one difference in this business case, and that is we know how it turned out. Okay? At least we know how it turned out today. So we're going to start with that, and then we'll go back to the beginning and say, okay, what did you do? And it's really a story of three things. The first I've mentioned, that is you got to be passionate about what you do. All of us are that. But to develop a company that can be successful, you may need many things, but two that I've focused on is you have to have a culture that motivates people to differentiated success. And then you have to have a strategy that creates value but is translatable down to everybody in the company. So whether it's me, Tim, Steve, the people in that picture, they've got to be able to understand what it is if they do it, they'll make the company successful and why, and be motivated to do it. But it also has to align with a value proposition that can indeed be successful. So we're going to talk about how we found that, the solution to that problem. So the end is we have grown. I think as Tim mentioned, we are much larger, but the point that he didn't mention is that we're actually less leveraged. So today we've significantly more profitable. We've done $7 billion of acquisitions, but our credit agreement ratio, credit agreement EBITDA to debt is lower today than it was then. We didn't do it by, and our market cap, which you'll see in the next slide, is 3.7 billion compared to 5 billion, and of that is about 1.7 billion of equity we issued in acquisitions. The remainder of that 7 billion was debt. Now, we'll stop on this chart for a little bit. When I started at RockTenn, we had a number of peers who were in basically businesses like ours, and they were, in order, Caraustar, headquartered in Atlanta. This is the Newark Group, which made uncoated paperboard and coated paperboard, which we did. This is Chesapeake, which was a large folding carton company that was going to go to Europe. That's Smurfit-Stone, which we recently acquired. This is Cascade, a large folding carton company. International Paper, our largest competitor, graphic packaging, another folding carton company headquartered in North America. And this is a chart that tracks value creation or destruction since 1999. Now, if you think our businesses are easy, you might think so because these columns are so short. But the reasons they're so short is once you've lost 100% of your money, you can't lose any more. But on the day I became CEO, if you had the wisdom to invest in the S&P 500, you have a cumulative return for 12 years of 16% on your initial investment. That's better than it's been for a lot of the period of time that I've been in this business. But in any event, it's not exactly, It's not 16% a year, that's 16% over 12 years. And you can see there are a couple of companies that have been successful. Temple Inland is being acquired at 9.5 times EBITDA by IP, so it explains some of their current, it explains about that much of that. And then there's RockTenn. So you have a company that has something that I refer to as differentiated results. And the differentiated results flow from a differentiated strategy and process of application to our business. So I want to start with, let's dial the clock back, and you're me. Many of you don't know this, but I was a lawyer for 20 years. I went in the energy business and ended up head of a pipeline company. And in 1999, I became CEO of RockTenn, and I knew nothing about the paper and forest products industry, nothing about how to make paperboard, nothing about folding cartons at all. And in fact, that was one of the reasons they chose me, because the industry actually was destroying value and they wanted somebody from the outside to do it. A fellow that had, with a partner, had grown a business from nothing to 400 million when they went public in 1994, basically said to me, you're going to succeed me. My view of the best way for succession to be successful is for the guy who's retiring to retire. I'm out, here's the keys, you drive. Okay. Well, there's a great thing about being the CEO of a public company that you know nothing about, and that is you're going to get a lot of advice. And I got a lot. And I put some of the advice that I got up here. Okay, packaging companies trade at multiples that are higher than paper companies, so why don't you disguise the fact that you own paper mills, become a packaging company, and you'll trade at a higher multiple. Okay, well, guess who gave me that advice? All right, now, plastics have higher growth and margins than paperboard, so you have a plastics business. Why don't you grow in the plastics business and shrink in the rest of the businesses? Does that sound like an investment banker? All right, here's another one. Pharmaceutical and entertainment packaging have higher growth margins than food and beverage. So you want to leave the food and beverage business that you're in. You really want to acquire pharmaceutical space folding carton companies, and that'll be a great way to succeed. We got some more investment bankers who basically said consolidations, of course, can change your marketplace. So what you should be is the consolidator in your space, and that'll be your value proposition. And then lastly, everyone said, please remember that capital expenditures in your business don't return their cost of capital. So if you do anything, do nothing else, don't invest in your business. This is not a joke, right? I'm not making this up. So we said, okay, that's good. But, over time, we did look at acquisitions because that was, I'm a deal guy. That's what I did when I was working. So one of the ways you could do it is, of course, you could acquire your way out of it. So there were a lot of deals we looked at that other people did. We had Caraustar, the unnamed peer, in another presentation, was the consolidator of the industry. They're bankrupt. All right, International, Chesapeake basically went to Europe and decided to roll up the folding carton industry in Europe. They went bankrupt trying. Plastics, Ivex was a business very much like RockTenn's, except they were putting it in plastic packaging, not paper-based packaging. Everybody knows plastics is better than paper. This business was acquired by Alcoa. They basically rolled it up and threw it away after about 4 or 5 years. Entertainment packaging, IP acquired Shorewood for 9.5 times EBITDA. IP basically sold it for an undisclosed purchase price about a year ago, and you know what an undisclosed purchase price means when you sell a business. And then in pharmaceuticals, MeadWestvaco acquired Mebane. There were many other examples of these acquisitions, and MeadWestvaco doesn't talk about Mebane very much in pharmaceutical packaging. Basically, none of these strategies created value for the acquirers. But the problem with all the advice I got and the problem with the acquisitions were they didn't address the real issues. They were attempts to run away from your current reality, run away from your business. Well, you can't do that and be successful. So what we needed to do was first identify what our challenges were. And boy, the first one that hit me in the face was we've got $103 million in EBITDA minus CapEx, and we got 8,700 employees. If you do the math, right, this is a big problem. This is really a big problem. For example, that's $12,000 of free cash flow for an employee. 10 years later, our health care costs us about $9,000, and under Obamacare, it's going to go to $12,000 in 2014, right? So health care was going to wipe out all the cash flow that we had per employee. So we got to figure a way to do that. We didn't have the best available technologies in our plants, and while that's a problem, it's also an opportunity. We had a bunch of small folding carton plants, a bunch of small recycled mills, so we didn't have scale in our converting operations. Our businesses were challenged. There was excess capacity both at the mills. There was excess capacity in packaging. Globalization was killing us. About half of our business was uncoated recycled paperboard and book covers, laminated furniture components. A lot of the stuff that you use that for was going to China. And then lastly, the internet came in. This is 1999, 2000. And basically, it gave everybody perfect price discovery because you could do an internet auction or request, see everybody's price. And so it was driving out any hidden niche market that had any margin in it. So these were the basic challenges. Like, okay, now I know what we face. So what did we do? Well, let me tell you, the first thing is, people always ask you, you're a public company, don't you hate analysts, don't you hate quarterly results? No. I'm working for a scorecard, right? I want to know how I'm doing. So I love to get the results, good or bad. At least I've got the results. So they say to you, well, do you manage for the short term or the long term? The answer, you got to manage for both, right? I mean, the first rule in business is you got to survive. You're a new CEO, you don't want to lose your job. So you got to do well enough in the short term that you don't get fired. So you have to manage to a certain extent for the short term, but you really are playing for the long term. And any CEO or CFO stands up here and tells you his problem is managing for the short term, he's just making an excuse, right? That's just an excuse. Fact is, we're going to play this game for the long term. Now, what we needed to do in our business was, I read a great book. I don't read a lot of business books, but occasionally I read ones that really stick. And I read one on strategic market positions, and I said, that guy understands. That's what I'm looking for. And basically, it's the concept of, I need to find a business that, if I'm the best, I can understand why I'm going to be sustainably successful. And believe me, that is not a given in all businesses. But you have to try to identify some, and if you have them, then that's where you're going to focus. And then you have to get great in those businesses. You have to be so much better than everybody else if you're in manufacturing that it's a joke just to survive. Then I looked at us and we said, okay, we know which ones they are. That's basically folding cartons, coated recycled paperboard. We're going to consolidate our plants into larger facilities. We're not going to attack the market to try to get the volume to fill them. We're going to fold our own volume in so we can get compensatory returns on the capital that is going to be required to do this. We're going to get out of the plastics business. It's no better than ours. It's small. Use the money to improve our businesses. Half our business is going to shrink, so let's go ahead and shrink it into defensible niches, what we did. And then our base business, we're going to play last man standing, because this is a very stressed business with excess capacity. But what we're going to do is invest to take that business to the left side of the cost curve. And if we're right, the right side of the cost curve is going to go out of business, and then we're going to have pricing power. And when we get pricing power, we're going to exercise it. So in 2004, I'm getting criticized all over Wall Street because our volumes are going down. We're not renewing our contracts, and everybody else is. And everybody else is redoing their contracts to get inflationary protection by passing through their costs. And they're saying, what are you guys doing? And it's like, we're playing last man standing. Because what I didn't want, the decision we made was to go short on contract duration and take the commodity exposure, because when everybody else went out of business, we wanted pricing power. And so 2004 was the inflection point. And if you look from 2004, we've been straight up, but we maintained the pricing power and the ability to benefit from the value that we created. And then last, right at the beginning, I thought, I got to make people understand, we don't care how big our business is. We cannot play the game for growth. We need to be profitable. And what we're going to do is let the business right-size itself to the markets we serve and the assets that we have that can make money in those markets. And then we're going to right-size our capital structure to optimize our return on invested capital. And that meant buy back stock. And this also was a nice message to people, which is, hey, there's no turning back. We're going to maintain the leverage right where the leverage should be at all times. And we're going to have to operate with a very narrow degree of tolerance. So that was the basic strategy, and that plan we've executed pretty consistently. But now you got a problem, which is you got to actually translate that into an approach that you can communicate to people, that everybody will understand and get behind. So this wasn't too bad. The big thing, and I'm going to come back to this, because to be successful, I mentioned you got to have the culture. So we're going to attack the culture. You got to speed up decision making. So I went to everybody and I said, we're going to reorganize this business, we're going to flatten it, and here's the rule. If your job is that somebody reports to you and you report to somebody else, you better change it, because if I find out, I'm going to fire you. Okay? Everybody in this company is going to have a full-time job, and they're going to do that job really well. And that says, and we're going to let you be successful. So we're going to empower action and change, and we're going to invest in our base business. We're going to invest for competitive assets, for competitive advantage. Now, why is that? If you want good people to work for you, good people want to be successful. They want to be empowered to be successful, and they want to have the support that they need to be successful. So if you're not committed to investing in them, both investing in their skill sets and investing in the assets that they operate, you're not going to get the best people. Well, I'm a believer that the best team wins. I mean, that's been a basic principle in life. So we're going to invest. We had to really improve the decision making. I don't have a lot of time to spend on that. I'm going to skip down to this one, which is be patient. I went to our board and said, look, this is the plan. This is not going to be thrilling, right? This is going to be boring for a while because we've got to grind this out, and it takes time to do it, and it's going to take time to develop the leaders. Some of them are sitting here today that can actually execute the strategy. Most of them are not in the chair that allows them to be the leader. It's going to be like 2 steps out before we can get them there. This is going to take time, but in the meantime, we got to make sure we don't make any big mistakes. So you looked at all those acquisitions we didn't do in the beginning. For everybody else who made them, they were, depending upon their scale, either the last big mistake they made or one that they learned a lot from. And then what I call solving the great company dilemma. And let me explain this. Right about the time I became CEO, Jim Collins published a very good book called Built to Last, and it's about great companies. Well, everybody wants to work for a great company. I wanted to work for a great company. In fact, I had. When I came to King Spalding in 1972, we thought we were a great law firm. We may have been or may not have been, but we sure thought we were. And in fact, the firm was very successful. It was the same thing at Southern Natural Gas Company. We thought we were the best pipeline company in America. I knew what it felt like. I loved it. So I want RockTenn to be a great company. Well, Collins basically says there's only 8 great companies in North America. You got to have a lot of things, 15% compound annual return to shareholders for 10 years, a lot of stuff that looked pretty challenging to us at the time. But you had to have a motivating ethos. You had to have something that your employees could say, this is good, I'm going to work for this principle, and it motivates them. And the best example he cites is General Electric, right, GE. We bring good things to life. Well, that feels pretty good, right? We could all sign up for that. Well, when you finish the roll of toilet paper, that little gray tube that toilet paper is wound around, that's us. There's a good chance we made that paperboard. A cereal box, we make basically paperboard, and then we make boxes out of them, and we sell empty boxes, okay? So try that one on. So what do you do in an environment like that? You don't allow someone else to define greatness for you. You don't let someone else define what success is. And I've showed you that picture of that person standing right there with a folding carton plant inspecting that paper. My belief is that the people I want to work with, the best workers in America, are people that are basically driven by the need for respect. And the way they get that respect is they do their job as well as they can. They do part of yours to earn your respect, and by earning your respect, their own respect is reflected back upon them. Those are the people I want to work with. Those are the people that I think will be successful, and I've got it. I know what to say. So I walk around and I say, RockTenn is going to be the most respected company in our industry. If I'd said we were going to be a great company, what's that? If I say we're going to be the most profitable, nobody thought that. But I can say we're going to be respected. Now, what respect enables you to do is to translate that into an action plan. And the action plan was very simple. It has 5 principles, right? We want to be the company that every customer in the industry would think, if I just had RockTenn as my supplier, that would be great, okay? So how are we going to be the company that every customer wishes was their supplier, whether they are or aren't? We want to be the company that every employee wants to work for. If I could just work for RockTenn, that'd be the best job in my industry. Then we're going to invest, right? We're going to optimize and standardize everything we do. We're going to empower people to change it and innovate so that as soon as somebody figures out a better way to do it, everybody's going to do it that way. And then we will do acquisitions when we find acquisitions that are accretive that can materially improve our company. So we take those principles and now you start slicing them down. If you're Steve, you can slice them down to the people in customer service, which is your customer, at us, shared services, your customer is the business unit. What do they want from you? They want the answer and they don't want any cost. So that's what we're going to do. You can take to the person on the running that printing press, what's your customer want? He don't want any screwed up boxes, right? He wants the same color, he wants the same thing every time. He doesn't want better quality than he needs because he don't want to pay for more than he needs. He just wants it the same way every single time. So let's focus on that. And now you need metrics. I can't go through everything that we did, but I'm going to pick out one example. And I hope there's none of our competitors here because I'm really going to show you the secret sauce. right now, and this is customer satisfaction. So you can actually measure your customer satisfaction. I don't care whether you're the Ritz-Carlton or RockTenn selling to consumer products companies. If you want to be the best in customer satisfaction, you got to find a way to count it, measure it, and improve it. This is a chart that CMS Research, who's worked with Steve and me at Sonat, works with us here, has developed. And don't look at the bottom half yet. Let's just start here. You start out in a very professional way serving your customers. And the first question is, on a scale of 10, rate your overall satisfaction with RockTenn. The amazing thing about responses to this, it's highly provable, it's statistically reliable. When you say 6 and I say 6, we mean exactly the same thing. If you say 10, it's exactly the same measurement. And the scale of value creation and differentiation in the marketplace is very narrow. And that is below about 7.8, you're at risk. Below 6, your customer hates you, he's your enemy, he's telling his peers, don't use RockTenn, they're terrible, right? At 8, at 7.8, you're beginning to be acceptable from a quality standpoint, but in a very narrow band, right up to about 9, you're absolutely as good as anybody in North America gets. Above 9.2, you're essentially spending too much money because there's no incremental value to be delivered through customer satisfaction. Now, I won't go into how this works, but we allow our customers to tell us what it is, if we did it, would get us a 10 if they don't give us a 10. And now we've got a blueprint of how to serve that customer. And we take that right down to the plant level, to the printing press, if there's only one press producing that customer's stuff. And we can say, this is what they want you to do to be successful, and then we set about doing it. First time we measured it, sigh of relief, 8.15, right? We didn't have enemies, by and large, but we were not differentiating ourselves on the basis of customer satisfaction. So we start on the long march, and we get to 8.83. We do a major acquisition of a company with much lower satisfaction than we do. We fall back down a little bit. We do the same thing, but we get to about 9, which is really very, very high customer satisfaction. And in a manufacturing environment, it's extremely high. And this is a blend of a number of businesses. These numbers here are really not statistically significant. So we basically have what our consultant says, a term I don't like, world-class customer satisfaction. But we have a business unit that for the last 4 years has had a 9.5 rating from its entire customer base on a statistically valid sample. The mode response from a customer who says anything other than I give them a 10, right? So you got a 9.5 average, got a lot of people are giving them 10. If you don't give them a 10, the mode response to the question, what is it RockTenn can do that you would give them a 10? The answer is, I don't give 10s, okay? So we have found a way to differentiate ourselves in the marketplace. Now the question you should be asking me is, well, wait a minute. You sell paperboard and containerboard. That's a commodity, right? Why do you care about customer satisfaction when you sell a commodity? Well, the answer is the following. Our products have commodity-like pricing exposure, but they're not completely commodities. And ultimately, it goes to a customer who has to use that product. So he wants it to show up on time, and he wants it to be exactly what he wants. And there may be other things that he wants. But in a commodity market, what we decided we want to be is that at any point on the pricing scale, right, whenever we get to the market clearing price, we want to be the one the customer picks. So we don't have to be the one who lowers the price to get the business. And playing that spread will differentiate ourselves from our competitors in a way that will create value. And it has worked. So 2004, I mentioned we got to an inflection point. It was lucky because that 180 million in EBITDA was now 130. The only thing that was good about it and why I kept my job was our slope of decline was less steep than everybody else's. And people did have faith the strategy was going to work. And the first acquisition that really made sense showed up. This is a paperboard mill in Demopolis, Alabama. It happens to be the lowest cost bleached paperboard mill in North America. What's bleached paperboard? If you have a Haagen-Dazs carton in your refrigerator, that white stuff that thing's made out of, that's bleached paperboard. Now, I got conviction that this business was better than people thought it was and was going to be better. That ultimately persuaded us to do this acquisition. I won't go into detail on all of the reasons why, but we paid $560 million for a business with about $33 million of EBIT. Part of the value proposition was to get this mill because people knew the mill. They knew it was a great asset. So instead of knowing we had 10 recycled paperboard mills sitting around the country, everybody knew we had a great asset. We didn't make the money on the acquisition out of this asset. It basically, for the first 3 or 4 years, made what it had always made. But we acquired a folding carton system that we were able to integrate with ours and invest in, and we created another $33 million of EBIT in acquisition synergies. So in basically 18 months, we doubled the profitability of the business that we acquired. Now, today to RockTenn, $33 million doesn't sound a lot, but when your EBIT, right, is in that range, and you acquire another company with EBIT in that range, increasing it by 50% is a lot. So this acquisition, our stock price was $12 a share when we announced it, immediately went to 10. Thank you very much for your confidence. But that acquisition was 53 cents a share accretive the first year. So if you do the math, you figure out, wait a minute, this worked. So 2007, that worked. We're looking around for other things that we can acquire. I remember Steve walked into my office and he said, Jim, the next acquisition's got to be $1 billion. I said, $1 billion? He said, yeah. He said, look. He said, and he had the charts and paper. He said, in order to have the same impact from an acquisition that we had from Gulf States, we got to do $1 billion. So I was, all right, Steve, we'll find $1 billion acquisition. So what I did was I said, well, this worked. Why did it work? And the reasons were there had been so much capacity driven out of this business that after 10 years of excess capacity, capacity was coming into balance. The pricing behavior in the business was getting better, looked to me to get better, and we could export our excess production, right? So it was like, okay, this idea worked. What else looks like this? And I'm sitting at the board of directors table at an AFPA board meeting. I'm looking around the table at all the CEOs who own bleach board mills in North America, and it occurs to me, they all own containerboard mills. Those are the guys that own containerboard mills in North America. So I'm going to go look at, I'm going to look at that industry. And what did I find? I found the same thing. This chart says containerboard in 2007 when we were loading up for the next acquisition. It is exactly the same charts. I mean, if I just took the names and dates off and showed you SBS 3 years earlier, it's the same chart. You have capacity being rationalized, demand is good, growing exports, operating rates above 90%, which gives you a pretty good feeling about pricing, and inventory levels are in check. So we go shopping. So we start looking at corrugated companies to acquire. We were very small. Corrugated was about 10% of our revenues. We had a small recycled mill in St. Paul, Minnesota. And we actually go through the process with several pretty good-sized companies. We don't find any we like. Steve's in my office saying, we need to go see Southern Container. I said, well, I had something else I was really interested in acquiring at the time. I was like, Steve, we'll get to that. We'll get to that. So for about 3 months, he's trying to tell me to go look at this company. I said, okay, what do you know about it? And he said, well, their EBITDA is about $144 million, and they're supposed to be great. It's $144 million. I said, Steve, that's $1 billion. I want to get in the corrugated business. We got $100 million in revenues. You want me to spend $1 billion on a containerboard company? He kept going. So I said, Steve, you want me to go see this company? I'll go see them. So we go and we see Southern Container. Have you ever played Monopoly and you land on Boardwalk, right? This is the first meeting. They basically, but it was funny because it was owned by a guy at 70% of the stock, and he was going to sell it to somebody that he wanted to sell it to because he wanted to protect his management. So we had to go audition. Look, we had to go down and tell him who we were, why it was that he should sell his company to RockTenn. So we made our pitch. We did. We just told him how we would treat his people, which is basically with respect. We said, I can't guarantee that any of them will get any particular job in our company. I'll guarantee they'll get the jobs they deserve. And then I went through the history of our acquisition integration, which basically proved that point. And he said, okay, that's good enough. Came back in and said, here's our presentation. And this company was fantastic. Southern Container had EBITDA margins that were 40% higher than the highest EBITDA margins of any public company in their business. They had a great leadership team that had grown this business from nothing in 1994 to about $800 million in sales. And he was willing to sell it to us for a reasonable price that allowed us to create value. Because in this transaction, there were not significant synergies, so we couldn't create a lot of value. This was much more of a true step out. In fact, in a $1 billion transaction, we said we were going to get $15 million in synergies. You tell a Wall Street analyst you're doing a $1 billion transaction, you're going to get $15 million in synergies. Believe me, that is not welcome news. They don't believe you, and they don't like it. But they did like this acquisition because we've been so successful before that they let us do it. Well, this one really, really worked. This is the lowest cost recycled paperboard mill in North America, the one I showed you the paper machine of. You'll notice that it's different than a virgin mill. Remember the virgin mill, you couldn't even see where the paper machines were in the picture because of all the pulping and recovery boilers and all the rest of the stuff. This is real simple. We take old corrugated containers in these trucks and we put them on a big paper machine and out comes containerboard. This acquisition was again highly accretive to earnings and generated tremendous cash flow. In about 2.5 years we paid off about 70% of the purchase price for the acquisition. Meanwhile, our stock price is going up, our free cash flow is going up, and our capacity to do other acquisitions is going up. So then it's like, okay, well, what are we going to do next? We got a good company. We're outselling how low cost we are. We've really got the lowest cost containerboard production in North America. We've got the lowest cost bleach board in North America. We've moved our recycled mills to the left side of the cost curve, so we're very low cost in our basic businesses. This is feeling pretty good. And in fact, what happened in the 5 years from the inflection point, we'd gone from 5% EBITDA minus CapEx margins, 9% EBITDA margins, to 17% EBITDA margins. We're in the same business, we're the same company, and 13% EBITDA after tax. And lo and behold, we are the most profitable company in the industry, and we have a 10-year, 15% compound annual return to shareholders, blocking and tackling and doing acquisitions with respect to which you have a high conviction they will improve your company. So what's the next one? Right? This is a chart I'm going to come back to, so don't look at the chart for just a second. One of the companies in our industry was Smurfit-Stone Container, and they had been a conglomeration of a great number of acquisitions in the containerboard space. They were not well regarded, and from about 2000 to 2008, they kind of went straight into bankruptcy. It took them a long time to die, but they were over-leveraged. They didn't do the things they needed to do to integrate the acquisition, and they were always behind the curve in terms of taking capacity out of their business. Not really a very well-regarded company. They went bankrupt in 2008. They came out in 2010, and three wonderful things happened to me. First one was a shareholder called up and he said, you ought to go to Smurfit and tell them they ought to let you acquire them and use your stock, because they'd be crazy to say no. Okay, thanks, Barnes. I appreciate it. That's a great idea. They happen to be twice as big as we are, you know, just out of bankruptcy, not really a great company. I don't know. But it kept, you know, bothering me a little bit. Then the second great thing was, in my business career, I've always looked for discontinuities. That is, something occurs and it's not intuitive. I look at it and I think, I don't understand that, okay? Because now I got to figure out what it is that's different than my understanding of the world. Smurfit put out its first full quarter earnings release after it went bankrupt, after it came out of bankrupt, and it made too much money. I looked and I said, I don't understand why they made that much money. And then the third thing was they were very smart. They, in their investor presentation, published this chart. Now this is this chart today. They published it 18 months ago, and this is the RISI cost curve. So a consulting firm puts a chart out that basically has their estimate of the cash costs of every mill in North America that makes containerboard. They do it for all paper grades. And Smurfit plotted their actual cash costs on that chart and put it in their investor presentation. And as I'm, you know, rooting around trying to learn what I can, get focused, I see this chart. And I say, if this is true, I'm playing Monopoly again, I'll buy it. There was another thing that they had done, which is they put this chart up. This is basically, they spent $450 million to $500 million modernizing their box plant system. They went from 150 to 100 box plants in 3 years. That's just what we had done for 10 years at RockTenn, right? And they took out $300 million of annual operating cost. And there was two answers: why they made more money than I thought, and why they should be acquired, which was their mills were low cost. Everybody knew they'd been underinvested. So the opportunity to do exactly what we'd done with our mills, which was apply technology to modernize those mills and increase their productivity, gave us a tremendous opportunity to create value. Now all we got to do is go to a company twice our size and convince them to sell themselves to us. Okay? So that's the only piece left. And then we got to prove the thesis, these numbers are right. So I went to them and I said, here's the deal. We can pay you a premium to market that essentially captures the value you expected to get out of this investment when you, the former debt holders of a bankrupt company who now own the equity, did this transaction. But you really should take half of the consideration in our stock, because you certainly want the opportunity to participate in the upside of this transaction. And they said, you know, we agree. And so We spent $5.1 billion, including liability assumes, to acquire Smurfit-Stone. And I think it has created a great company. I'm going to give you a 30-second commercial on it in a second. But the tale of the tape is the first month we owned Smurfit, which was June, the only month for which we published financial results, it was 23 cents a share accretive. But it also made us a much better company because the assets are much better than people think. We have the opportunity to do exactly what we've done to improve those assets, and by applying our business model and discipline to that large platform, we believe will create tremendous value. In fact, the synergy number we've published, and we think we're 3/4 of the way there, is about 150 million, but we think we can improve the profitability of the business by 400 million more in the next 2.5 years. And I really believe we'll do it. I mean, we're serious. We've got it laid out. We know how we're going to do it. Now, the reason I wanted to own those mills is, unlike the majority of our mills, these were virgin mills, just like that Gulf States mill we acquired. And they're located in North America. Containerboard is a global commodity. In the last 10 years, China's gone from nobody to the largest containerboard manufacturer in the world. It's all recycled containerboard. And this is a global cost curve. This is how much it costs to make containerboard anywhere in the world. We win. North America, $322 a ton. Asia, which includes China, $419 a ton. Europe, which is the other big place, $357. So we have a significant cost advantage in the United States. And why is that? There are two places in the world where pine trees grow prolifically: Russia and the southern United States. If you want to make containerboard, you have to use pine because pine has long fibers that give strength characteristics to paperboard that short fibers do not. And today you could never build a virgin containerboard mill anywhere in the world because you'd never get a return on capital. It's cheaper to build a recycled mill. Remember all that pulping stuff out there you'd have to build? You'd never permit one in the United States. So the installed base of virgin containerboard manufacture is what I refer to as a globally strategic asset. It's also globally strategic because when you make recycled paperboard, over time, because you have to refine the fibers, the microscopic paper fibers, they get shorter and shorter and shorter. And after about 5 or 6, maybe 7 times, they just go away in the wash water when you try to make the paper. They're gone. What does that tell you? It tells you that you need a renewable source. Somebody's got to be making virgin containerboard to give you virgin fiber to keep the string going. Well, today, something like 75% of the global capacity of containerboard is recycled. And China is expected to increase that by about 30% in the next 6 years, all of it recycled. One thing I can tell you is that doesn't work. Right? I mean, there's got to be additional sources of virgin fiber, but we happen to have the lowest cost source of virgin fiber in North America in an industry that basically is in very good supply-demand balance. So I love the assets we got. The acquisition's been unbelievably well received by our customers and our employees. In fact, we are respected. They knew it, and they would like to be part of it, and I think we've got an unbelievable opportunity. I put some more data up I really didn't have an opportunity to talk about, but the deal's been very successful, but the story's the same, right? Everybody, I'm out there, you got to change the culture. You got to let people know what it is. If they do it, they're going to be successful. So it's here we are. You're going to exceed your customers' expectations every time. We're going to invest in your assets for competitive advantage. We're going to spend $480 million this year, and continuous improvement forever. Whatever it is we're doing today, it's got to be better tomorrow. We've got to make it better the day after that, forever. Right? And that is the way we've been successful and the way I anticipate we'll continue to be successful. If you really like more on the current story, again, I refer you to our website. Right? I always give my bibliography. I mentioned Jim College, Built to Last. I don't really recommend that book. The books I'd recommend for today is a book called First Break All the Rules. Who's read First Break All the Rules? Anybody read that? Everybody in this room, if you're in business, ought to read First Break All the Rules, because it was published by the Gallup organization. It's based on over 20,000 surveys of employees, and it basically is, what is it that you should do to attract and retain the best employees in your business? And this is science-based, right? They're not making this up. This is what people tell you. And people generally in psychological surveys, they're going to tell you the truth. So just read First Break All the Rules. The second one, I've been saying this since the book came out, but you've all heard about it now because of the movie Moneyball. Moneyball is about database decision-making and the fact that what you know is likely to be the thing that's going to hurt you most, right? And that's true. It's a great book on that subject. And then the last one is Winning Decisions. As we all know, human beings are wired to make bad decisions. You got to understand how you're wired so that you can overcome it and make good decisions. And this is a great little eye-opener on that. So that's the story. Those are the takeaways. And I think I have a few minutes for questions, but I know people are probably anxious to wrap this up. So thank you very much.
Well, we do have a few minutes for questions. This is a very crowded room, so more than ever, if you've got a question, please raise your hand. We'll get a microphone to you, and as always, we're putting this up as a podcast, so very important we get your question as part of that. So any questions?
I enjoyed your presentation. Thank you. On a personal question, your transition from being an attorney to, quote, being in the business world, could you just talk a little bit about that and how you went through the experience and translating the one skill set to another?
Well, I was always in the wrong place as an attorney, right? I went to law school because I came out with a BA in American Studies, so what are you going to do with that? You go to law school. I came out of law school with 2 children I didn't have when I entered, so what are you going to do now? King and Spalding, right? So I'm a lawyer. I think you really have to have passion about what you do. I think business is really fun. So the whole time I was a lawyer, when I'd be working on a deal, I'd be looking at the accountant, I'd be looking at the investment banker, and I'm thinking, I want to be able to do their job the next time something goes through, right? And so I basically would read the accounting pronouncements. I mean, I was just doing a lot of stuff. We had time in those days. You weren't working 3,000 hours a year. But I was basically always trying to figure out how to do it. And I had great people. Doug Ivester, who was a big contributor to this, was a great mentor of mine. Doug was unbelievable because if he liked you, he'd teach you. And all you had to do was ask him, and he was going to tell you exactly why he was doing what he was doing. And Doug was really smart. And I had that all through my career. So I was really, I just found the right place. And so the transition didn't really exist. Learning the job, you can learn a business, right? I guess the best thing for me, though, was that it didn't come too early, because I put up there that we had to be patient and make no mistake. If you're a CEO and you think you've got 3 years or 5 years to have an impact, the pressure on you to do something big and do it right away is really, really hard. I knew from our board that I had time. They were going to stick with us. We had the right strategy, and I was going to work for 10 or 15 years. So I just wasn't forced to mess it up in the beginning, and that was tremendously enabling and empowering for me. Thank you. Yeah, we're going to get you a microphone. Please hold on.
You mentioned how important the customer satisfaction portion was. Can you help us know a little bit more about how you went about that process of gathering the customer satisfaction information from those?
Yeah, Steve actually had found this business when we were at Sonat, and so we just brought it to RockTenn and basically told our people we're going to do this and we'll get the results. And CMS basically surveys your customer base. So for us, it's generally consumer products companies or manufacturers of products that they consume, that they use in their process. We actually write a letter to, you're the person who basically is in charge of our supply relationship. So you know more about RockTenn supply than anybody else. You might be a plant manager, purchasing, whoever it is. We're going to figure out, you're the person that knows the most about the RockTenn relationship. If you're Procter & Gamble, there may be 4 or 5 of those people, but we're going to identify that person. Write you a letter, ask you to participate. We tell you that somebody from CMS is going to call you in the office at a time that you arrange, and we need about a half an hour of your time. So this is not a call at dinner time. We're not, this is somebody has agreed, I will talk about RockTenn. Then we go through a series of questions, and they're asked by professionals who can record what you say. So we say, please rate your overall satisfaction with RockTenn on a scale of 1 to 10. You say 8. We say, please tell me what it is RockTenn could do that you give them a 10. And then they keep asking that question until you don't have anything else left to say. And then they record that perfectly, okay? Next question. Please rate RockTenn's quality on a scale of 0 to 10. Same thing. Don't get a 10. What can they do? You get a 10. You give them a 10. Why? Okay? And then we just keep asking until you don't have anything else to say. Then you can really focus this. There are other questions that you can ask. One that you typically ask is, would you rate your overall satisfaction of the price-value proposition of RockTenn? And what you're hoping for is you get a lower score than your overall satisfaction, because if the scores are the same, you're not charging enough, right? But you can calibrate from your customer base your pricing strategy and the effectiveness of your pricing strategy. And it's the same deal. Well, that information we can then break up, right? If it's Procter & Gamble, I don't know how many facilities are associated with it, but we can actually track the responses down to the individual facilities. But for many, it's just one. This is incredibly powerful, right? And then all of us have customer satisfaction as an element of our bonus plan. If you're in a bonus plan at RockTenn, you're going to get bonused on customer satisfaction because we want you to know we're serious. Like this is the way we're going to win. This is the way we're going to differentiate ourselves in the marketplace. Thank you for your question.
You talked about acquiring a larger company, and culture is a huge part of your success.
Right.
How do you measure if your culture is taking over theirs and not the other way around?
Right. That's the big risk, right? Because one of our guys was in exactly this situation. He remembers when they acquired the company, and the guys came in and said, just you wait, because pretty soon you're going to be working for us, right? And in fact, that's what happened. So this is a real risk. You're exactly right. The first thing is you got to make sure that the people who are leading believe it, you can trust them, and then we're out communicating all the time. I mean, I'm on the road all the time. All of our people are on the road. We're communicating at every level of the company, and we're putting in our measurement systems. We've already surveyed 500 customers of theirs, break that information up, got it out to the plants that they understand, and we're doing the visible things, right? We're investing in their business. We're communicating to them exactly what our priorities, exactly how we're investing, so the people understand. And then you just have to go through a process of you change the people or you change the people, right? I mean, if they're either going to change and behave or you're going to change them. And people get it, right? They understand. So it's an iterative process. But very fortunately, this is very positive. So when if you tell people who want to be successful, who basically work for a company that went straight into bankruptcy, that for 10 years just skated on it and went in, and you tell them, they know who we are. They know what our results are. And you say, this is the way we're going to do it. You're not getting a lot of resistance.
Yeah, we got time for one more question.
I'll let you guys know.
With increased healthcare costs as a growing concern for companies and individuals, is there anything that you are doing to lower those costs?
Yeah, look, all right, the questions for the podcast is with the cost of healthcare going up, what are we doing to reduce the cost? And the answer is exactly the opposite of Obamacare. If you want to reduce your healthcare costs, you need to have people have choices that enable them to control their share of the cost of healthcare. So we have something we call consumer choice, but it is by far the best healthcare we offer. It's also the least expensive because it actually involves people in the healthcare choices and they have money in the game. We subsidize people's choice to get out of PPO, preferred provider plan, out of a HMO or whatever, get into consumer choice because we know it's the best coverage for them. The big issue is you have a large deductible that you have to satisfy. And the deductible is the thing that makes it work. Because if you have a large deductible and it's your money, if you don't spend that deductible, you keep it at the end of the year, you're not going to the emergency room on Sunday night if you can wait till Monday morning, right? You'll never buy anything but a generic drug. And you're going to manage your health care. You're going to participate with us to keep those costs down. This works. And this is like 15 to 20% lower in cost. I can prove it to you than a traditional preferred provider. And people who are in it like it. Because they know, look, the less our health care at RockTenn costs, the better health care RockTenn can provide us, right? And the less, I want the opportunity to save. So if you get people engaged in their own future, right, engaged in solving their own problem, and you communicate to them, you can go on a website, you can take your PPO, and you can go right in, you can say, here's my bills from last year, I'm going to put them in the program, and here's what it would have been under the consumer's choice. It'll give me an answer. Say, you would have saved X. Some people you wouldn't have saved. It doesn't work for everybody. The vast majority of people it saves, and they'll make that choice. The hardest thing is that $2,000 deductible, and if you make $35,000 a year and somebody says, guess what, the first $2,000 is coming out of your pocket, that's a problem, right? So what do? We put a big deposit in their healthcare savings account, and we subsidize them into the program because we know that over time they'll benefit and we'll benefit. But if you put people in a healthcare plan where they don't have any responsibility for the cost, I mean, it's just like, how can you maximize the cost of healthcare the fastest? Right? What does Obamacare do? Right? It's free.
All right. Thanks very much. On behalf of our alumni board, Jim, I'd like to present you with this glass sculpture from a local artist, Loretta Eby. Thank you so much for your presentation. It was terrific.
Beautiful. Thank you very much. It's great. Appreciate it. Thank you all.